the destruction of the currency adds another dimension to what we saw in the 1930s, and that is the trashing of personal wealth. Anyone who has financial assets, anyone who has cash, deposits in the banks and all the rest of it, is going to lose, and lose possibly everything.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a returning guest of some renown. Alasdair Macleod is the head of research at goldmoney.com. He joins us again this Wednesday, July 8th, 2020. Alasdair, thank you for working us into your schedule.
That's my pleasure, DK.
I was glad we were able to catch up to you because you've been prolific in your writing, both your research articles and tweets and so on, all hammering home that provocative message that echoes what you've been saying quite consistently and clearly for the past quarter at least, and that is that you see imminent concerns about a systemic banking crisis as well as the likelihood of a fiat currency crisis by the end of the year. Could you bring us up to date on what are the main factors that are causing you to basically be shouting from the rooftops at this point? You're not a fellow who's generally led to, hyperbole. So when you start saying things like systemic banking crisis by the end of this month and fiat currency crisis by the end of the year, our listeners are really perking up and wanting more understanding from your standpoint.
Yes, we have a credit cycle, and I think if you understand that, you know that each credit cycle is punctuated by a contraction of bank credit. The amount of bank credit outstanding is enormous. And the problems that the banks have is that they don't want to lend any more bank credit. If anything, they want to claw it back in. But they have a problem. If they do that, then their customers go bust. So they'll take it in where they can. And we're already seeing that. For example, in the gold market, they tried to restrict their market making in the futures, or rather their trading positions in the futures, but they can't claw that back. They've got the same problem in all derivatives as well. Their market making in equity markets is a similar story. It's all becoming limited and therefore more volatile. And if you look at the scale of payment disruptions in the economy brought about not only by the coronavirus, but by the economic conditions that were developing last year, you can see that the banks have a real problem. They are highly geared. If you look at their share prices, they're trading on average at considerably less than book value, which basically means their gearing capital to balance sheet is just horrendous. I mean, I've got one instance in France, Société Générale, where the relationship of assets on the balance sheet is over 100 times the capitalization of the bank. Now, this is not good. It really is not good. So we are informed by not only the current position, but also by the fact that every credit cycle ends up with a period of bank credit contraction. And when the situation is severe, then you get a banking crisis. We had this in 2008, 2009, 2008 with the Lehman Brothers. Other banks were rescued, but the fact that Lehman wasn't really accelerated the crisis. Today we have banks who are meant to be better capitalized, but in fact are not. And consequently, when one fails, because they're all working to Basel III regulations, as interpreted by the local regulators, who all talk to each other, they're all in the same boat. So when one goes, they all go. And we've already seen the banking crisis start in the sense that from last September, the Fed had to inject massive amounts of liquidity into the banking system through the repo market. Today, we see the creation of bank reserves. Again, this is injecting liquidity into the banking system. So the liquidity issue is there. It's just a question of whether it tips into a banking crisis. And I think that anyone looking at the situation with unbiased eyes and see actually it's very difficult to avoid. Not only that, but with customers going bankrupt all the time, with the last quarter day, rent payments, rate payments, all those bills, those quarterly bills, not being paid. Shopping malls going bankrupt. Property is commercial property, office property is all in dire straits. And this, of course, is the collateral that banks hold against loans. It's failing. It's as simple as that. And I think that it's only a very short matter of time. I think probably by the end of this month that this banking crisis will emerge from being just a liquidity crisis being deferred by the central banks injecting money into their commercial banking networks into a full-blown crisis. And when that happens, of course, the whole scene changes. We'll be looking at overvalued financial assets. We'll be looking at the banks' share prices disappearing. There will be the confusion, are banks going to be bailed in or bailed out? It is potentially a huge, great mess, and it's looking increasingly difficult to avoid. And today, we see gold is now trading over $1,800. The banks are desperate to keep it down because they're short and they cannot close their positions. So you can see that we are coming up to some sort of crisis. Quite how it evolves, I can see roughly how it might evolve, but we'll see how it actually does evolve. But the one thing we will know is that the world will be divided into before the banking crisis and after the banking crisis. After the banking crisis, we'll be looking at a very, very different situation. We'll be trying to work out what the cost of nationalizing the banks or taking them into public ownership will be for different, for different countries, whether it's America, the EU, Britain, Japan, China, perhaps. China already has them in national ownership anyway, so that's probably not so much of, that's a different issue, if you like. So this is a very, very difficult time. And I think that when we see how much money has got to be printed to finance it all, because it's not going to be raised in taxes, you can bet your last tax dollar on that one. This is going to be printed. We're all going to be robbed of our wealth through the debasement of our incomes and our savings by the quantity of currency in circulation being expanded extremely rapidly.
You've just painted a very bleak but credible picture, and a lot of us have been watching this train wreck in slow motion for some time. I'm going to come back and circle back and ask you, why at this time are you finally saying, I think it's here? But if you could first take us back in time, because you mentioned that this was not a lot of these, like business closures and that sort of thing, rent not being paid and all that. We can point fingers at the restrictions that are clamped down on the COVID virus. But back in September, when they started the liquidity injections with the bank repos, and we had an interview in fourth quarter with an insider from the trucking industry, and we entitled that interview "Economic Red Alert from Inside the Trucking Industry," that the economy was, as you've said in the past, already on its knees for several quarters leading into this. How much of the setup for today have you seen coming, even before anybody was even mentioning the virus?
Well, we go back to September, but we can go even back further than that. The introduction of tariffs against China by President Trump made international business basically shudder to a halt. And we could see that this affected other economies like Germany. Germany went into recession at about that time, simply because China is Germany's largest customer, if you like, in terms of exports. What it does is it replicates what happened in the late 1929 and into the 1930s. In late 1929, October 29, Congress passed the Smoot-Hawley Tariff Act, and that raised tariffs by around about 20 to 30% across the board. That was signed into law by President Hoover the following May or June.
Foreign trade tariffs, trade protectionism.
Yeah, trade protectionism. Okay. it so happened that occurred at the end of a long period of credit expansion. We had the roaring 20s. The reason the 20s were roaring was partly due to the massive expansion of credit under the new Fed. The new Fed was, basically beginning to run things from the money side, if you like, even though it was operating under a gold standard at $20.67 to the ounce. Now, guess what? We have exactly the same situation today. After a long period of credit expansion, roughly 10 or 11 years from 2008, taking us into 2018-19, then we have these tariffs on top. It's exactly the same mix. So, we've got a replica, if you like, of 1929 to 1932 in the stock market. And if we trace it, it's doing exactly the same thing. We had the initial fall when in October 1929, the market fell 35% top to bottom. It then recovered and continued to recover through to around about May the following year, when Smoot-Hawley was finally signed into law by President Hoover. And then we had a long decline from that time, May 1930, to the middle of 1932, over which time the Dow lost 90% from the very top down to the very bottom. And that was followed by banks going bust, unemployment rising, Hoover's policies of trying to maintain prices of agricultural product in particular, to try and maintain wages, to stop employers cutting wages, those policies were failing. It was disastrous. So in Inauguration Day, that was 1932, March 1932, Hoover was the most unpopular man in America. The most popular man was the new guy, FDR, who pursued exactly the same policies. Reflation, trying to get the thing going, subsidizing this, subsidizing that. The banks, 4,000 banks failed in 1934 alone. This was well into his first term. So, that is the scale of what we face when you get the combination of a period of massive credit expansion and trade protectionism on top of it. It has a sort of synergistic effect, which can be extremely unpleasant. Now we have the coronavirus, and what the coronavirus has done is it's speeded up the whole process. And when I look at President Trump, I see him as being an interventionist in the same way as Hoover was. They've got different. He's got different priorities. If we could work them out, but he is an interventionist. You didn't get into this with a budget deficit in the current year originally intended to be just over $1 trillion. Now you're looking at something going to somewhere between 3 and 4 on an annualized basis. So Trump looks like a Hoover, a latter-day Hoover. Now, if I was Biden, I would market myself as a latter-day FDR, and he will be immensely popular. I could see, it's so obvious. Now, is this good? No, it's disastrous because they're following exactly the same policies that we saw that led to the longest depression in economic history. Is that good for us? Obviously not. What's it going to do to the currencies? Well, in those days, you had a gold standard, which allowed Americans to freely exchange their dollars for gold until, I think it was April 1933. Gold ownership was then banned. You couldn't even own gold certificates. And the following January, the dollar was devalued from 20.67 to $35 an ounce. Nowadays, we don't have that sheet anchor. I know it's a sort of tenuous thing, but the point is that in those days, the dollar hadn't long been off the gold standard. And when I calculate the degree of reflation that the Fed did, because the Fed did exactly the same actions as it's doing it today, it created about $300 million of credit. QE, in effect. Now, that $300 million, if you work out its value today, relative to the gold price is $26 billion. We're doing 1,000 times that today. 1,000 times. This is going to be absolute disaster. So on top of what's happening to the economy, which is the problem, if you like, that has been created by the combination of a stage in the credit cycle plus trade tariffs on top, in combination with that, we're going to see the purchasing power of the dollar decline even faster. I mean, the increase in money supply from the end of February to the end of June was running at an annualized rate of 107%. I calculated it this morning. That's M1, 107% monetary inflation. And they haven't even got started yet when you can see what's ahead. So again, coming back to a banking crisis, when that becomes obvious, and it may not start in America, it might start in the EU, it might start in Britain, because Barclays are horribly geared on the metrics that I've just provided. On that basis, you can see that the destruction of the currency adds another dimension to what we saw in the 1930s, and that is the trashing of personal wealth. Anyone who has financial assets, anyone who has cash, deposits in the banks and all the rest of it, is going to lose, and lose possibly everything. So it's not nice, it's very unpleasant, and I think that additional factor is something we should, compared with the 1930 experience, is something we should all be aware of.
This question, I think you've touched on most of the elements of this, but I wanted to follow it up because it's so suited for what you were describing. New World Forward asks, how do you think banks will respond to the huge wave of non-performing debt caused by defaults due to COVID? Will there be bail-ins? Will the central banks buy the debt? Will governments bail them out with taxpayers' money? How will the banks save themselves from bankruptcy this time?
I think it's a very good question. We can rest assured that the central banks and government treasury departments will do everything they can to stop the ordure hitting the fan, if you like. So I think that's the first thing we must admit. But somewhere, one of them is going to fail. Of that, I'm absolutely certain. When it comes to the difference between bail-ins and bail-outs, the bail-in, basically the bondholders and large deposit holders end up paying the cost of the bank's restructuring, if there is anything left to restructure. I think it was one of the G20 meetings back, I think it was probably 2012, where it was agreed at that meeting that all nations would introduce the bail-in option so that, and this is the way the UK government put it, so the taxpayer wouldn't be on the hook for banking failures. I mean, come on. Anyway, well,
so you're going to steal the depositor's money at the bank rather than having him send it into the tax man, and that protects them.
Exactly. Now, of course, the consequence of this, if a bail-in was tried, basically what it would do is it would collapse the bond prices where banks are a counterparty. It would just collapse them, full stop. It would create a run of deposits from perceived risk into perceived safety. Now, where that safety is, God alone knows. In America, I would have thought you could be looking. I won't mention specific banks which are weak, but if you have let's say a couple of $100 million on deposit with a weak bank, you're probably going to transfer it very, very quickly to JP Morgan as the safest bank there. So you can see that makes things far worse for the weak bank. In a sense, it can be covered up because what the central bank does is it just provides liquidity to the bank to replace the 100 million that you've taken out. But it's a problem if it's not just you doing it, it's everyone doing it. And that is the likely consequence of a bail-in. So I think bail-ins are extremely dangerous, and I would hope that the authorities would take very care not to use that option. The problem is that they might try it in a smaller bank, but that would create exactly the same problem.
There's a question here about the scenario that you see most likely in terms of how this plays out in a timeline. HS asks, I have a feeling that governments, feds, banks have a D-Day plan to collapse and reset the whole monetary system in the shortest time possible, perhaps over a long weekend, rather than drag things out over years. What are your thoughts on that?
I don't see it at all. What I can see is a bank holiday in inverted commas, but basically that's to try and sort out an existing problem. I mean, for example, during a bank crisis, they may well just shut the banks for a week or however long it takes for them to try and sort it out. But the idea that somewhere in the wings, they've got a new currency which they're going to suddenly issue, there's going to be a complete reset, if you like. No, I just don't see it. There is a lot of concern in the central banking community about what is going on. Of that, there is no doubt whatsoever. What they're looking at is they're looking at using cryptocurrencies as a means of insulating the system from the sort of crisis that you and I are talking about. But the timeline in getting those going is probably 2 or 3 years. What we're seeing is now. And I don't think that a crypto solution from the central bank is going to, I don't think it'll fly. And in any event, what they're trying to do with it is they're trying to restrict our freedoms even more. That is basically the agenda, which is destructive of the economy. It's as simple as that. So I can't see a solution there. I don't think the planning is there at all. And in any event, history tells us that unless you back a currency with gold or silver, then any attempt at a reset will fail, and it'll fail very, very quickly.
Now, you've mentioned that in the past, that any fiat for fiat replacement is just going to fall flat on its face right away. This is a question that I think you've talked quite a bit about, but it's a good one I think that a lot of our viewers are having. And I promised you earlier that I was going to ask why now, because with all the crazy stuff that's been unprecedented scales, you said we're 1,000 times more on the currency debasement and in liquidity injection than we were, back in the eve of the Great Depression and that sort of thing. Okay, so we've been doing this unbelievable, unfathomable scale stuff for some time. People sometimes wonder why can't, if we're already in Neverland, why can't we just stay in Neverland longer? Carl Jan Grankvist asks, thank you for your work. I'm curious, how did you come to the conclusion that there might be a banking crisis within a month and a dollar collapse by the end of the year? Not details, but more qualitatively. So why now?
Why now? It's an excellent question. I think the starting point of this, and I wrote an article about it, was around about the 23rd of March. Suddenly, the world changed. We saw gold go up, having been knocked down. The gold-silver ratio peaked. The dollar trade-weighted peaked at 102 and a bit, and started going down after that. The S&P turned round and suddenly started shooting up. Now, these are sort of disparate things, but you can see that there is a lot of financial confusion from that inflection point. If you stand back from it, I see the Fed having taken the most impossible burden on itself to save the world, in effect. It would be very bad at saving other economies. That is not its remit. It has a responsibility, but not a remit, if you see the distinction. So if we just stick to what the remit is, the Fed basically has to support the banks. It has also taken upon itself, through the banks, to mend all the supply chains which are broken. And the total number of supply chains, so far as we're aware in America, is of the order of $38 trillion. That is the gross output. It is the payments that go from one process to another process to another process in the manufacture of goods or the provision of services. So $38 trillion. Now, not all that is broken, but it could easily be 20 trillion of that broken. So how does the Fed rescue that? The banks are unwilling to pass this on because they're already up to their necks in dodgy loans, which are becoming, which are beginning to default. They don't want to increase the position. Yet the Fed has to do this somehow. Now, inevitably, because you've got this problem that the banks they really cannot do what the Fed wants them to do, the bankruptcies in the United States and the same elsewhere are going to overwhelm the banks. Now, this last quarter day was the sort of moment where a lot of people stood back and said, I can't go on. Now, we know that. We know that from talking to people in business. We know that from getting a feel of what's going on, looking at the way the bankruptcies are mounting. What we haven't done is taken that further and think, what is the effect on the banks? The banks have a huge problem, and they are financially weaker than they were at the time of the Lehman crisis. How it hits the banks, I mean, there are various ways it hits the banks. In direct loans, that's a problem. You've also got collateralized loan obligations, which in total in America are roughly the equivalent of the whole of the American banking system's equity. Now, a lot of that is on a balance sheet. As well as that, the other thing you've got to factor into this is that the economy isn't just simply Boeing, General Motors, big behemoths like that. 80% of any economy is small and medium-sized businesses, like you and I trying to earn a crust, doing something without actually being employed by someone else, or local builders or plasterers or taxi services or whatever. That is 80% of the economy. Are the banks going to lend money to them? No, these are the first people they cut out. So you can see that the crisis is brewing. Now, when you get a collapse in a currency, and this is where I think it started on the 23rd of March, I think that is a marker point. What happens is you go through a series of events. The first thing that happens is that foreigners start selling your currency. Now, in the case of the US, so far as we're aware, foreigners own roughly $27 trillion worth of assets and cash. A lot of that, I can't remember the figure, but it's something like $6.75 trillion is in US Treasury stock. So when you have got such a huge amount of foreign ownership of your currency, and they've got problems at home, and they see that the trade, which they assumed would be around in a couple of years' time, in other words, they're seeing their sales grow and grow and grow and grow, therefore they would hold more dollars than they would in a situation where they see trade contracting and contracting and contracting, foreigners start selling the dollars. We've already seen this. That was the 23rd of March when the dollar trade weighted peaked. The tide turned on the dollar. Now, given that you've got $27 trillion worth, now it's not all going to be realized because a lot of that is portfolio investment. And if you get a collapse in the stock market, which I'm certain will happen at some stage, probably fairly soon, then money is just going to disappear. So the foreigners will be in a situation where they've lost a lot of money, they've got to rescue what they can, and they will come out of it. I mean, it doesn't matter how bad their own currencies are, they need that money at home. So there is going to be substantial selling of dollars compared with other currencies. The next stage is American citizens begin to look at the dollar. They begin to look at their own currency. And what they will see is that pricey SUVs and all the rest of it not being sold, the prices aren't going up. But the prices that are going up are life's essentials, food, energy, and so on and so forth. So forget the CPI, just look at the individual experience. If you're unemployed, the cost of food. If you're, unemployment is going to be huge. Let's not get this wrong. It is going to be huge because of the supply, the disruption to all the supply chains.
Absolutely.
And the fact that the banks aren't lending money to 80% of the economy. So you can see that very, very quickly, the ordinary man in the street is going to be drawing down on his money reserves in order to just live. He will be drawing cash. Okay, helicopter some more in if you like, but he will be spending it on food. Some of us are lucky and we have enough money that we don't have to do that. But when you have got, and this is figures admitted, and we've got exactly the same thing in this country. Again, 80% of the employed population in America and in Britain live from paycheck to paycheck. They don't have the resources to bridge, sort of to say, well, thank you for the helicoptered money, Mr. President, I'm going to sit on that. They don't have that ability. So you can see that quite rapidly, food prices are going to start spiraling upwards. They've already started going up, as I'm sure you would confirm from your own experience. They're going up here too, quite rapidly. Commodity prices start rising. One of the other things that happened on that 23rd of March was the copper price bottomed out, and that started taking off. Now, that's interesting because the Chinese are getting their economy going. But the Chinese, they are getting their economy going. Now, whether it lasts or not, I don't know. They are spending money on infrastructure and all the rest of it. We won't ask about the monetary effects and so on and so forth. That doesn't involve us. It'll involve the Chinese, but not us. But the fact is that they are buying copper. They're buying other materials because they want to get their economy going on a reconstruction basis. And that is absolutely clear. So commodity prices going up, dollar going down against other currencies. Other currencies will start going down as well, incidentally. But you can see that this could happen very, very quickly. And if I look at the final piece of this jigsaw, and that is the Fed's policy of doing everything it can to support financial asset prices, and in particular, keeping the bond yields for US Treasury stock as low as possible. When they fail in that, the currency will go. And that was the experience of John Law in France 300 years ago. From the top of the market, more or less, at that time, which was 28th of February, 1720, by the following September, there was some notional value in the shares of the Mississippi Venture, but his livre, his currency, was worthless on the London exchanges. And that was 6 months. And you look at all the other currency destructions that we've seen throughout history. 6 months about does it. This could be quicker. I mean, it could be quicker. So we see gold going up through that $1,800 level today. We see, and I've written about this today. You probably haven't had a chance to see it, but
I did.
Well, okay. So you will see what I was saying, and that is basically the bullion banks are short, and there is no way in which they can cover those positions. It's leading up to a potential crisis on COMEX, which is how I entitled it. So all in all, this thing could happen extremely quickly. And it's the balance of the evidence that makes me think that by the end of this year, fiat currencies could be toast.
We have a related question about, you mentioned the COMEX and how metals are going to play a role in what's coming. UFO Don America says, who decides the value of gold when it resets? Like what country, government, or entity, or person? And will the value be the same in every country?
I'm not quite sure in what context he's asking the question. All the time, the price of gold is actually determined by the markets. There are players in the markets who can manipulate the markets, and we do see that. We see them collectively in the form of bullion banks trying to suppress the price. The ultimate form of manipulation is when a government ties its currency to gold but doesn't back it properly with gold. In other words, instead of having a gold substitute, by which I mean a piece of paper which is exchangeable for gold on a set quantity, you end up with pieces of paper which say that, but actually are not backed by gold. Now that is rigging the market, if you like, in every sense of the word. I think that at some stage we will get back to gold and silver as being money, and the pieces of paper produced by government will have to be credible substitutes. In other words, they will have to be backed by gold or silver, whichever standard they happen to take. I've written that Russia is on the way to doing this, potentially. I think the one fault that the Russians have is that they still charge sales tax on bullion for private individuals. So private individuals haven't accumulated any gold. China is different. China, they've encouraged people to buy gold, so much so that the private citizens own up to I mean, the estimates are around about 17,500 tons of gold, which is an awful lot of gold. But it is a big population. As well as that, I have some evidence that the government has accumulated a lot more gold than they've let on. Now, this is important because if they decide to abandon the dollar, and that's not an easy decision for them, incidentally, but if they decide to do it, then at that stage, they have the gold reserves basically to go on to a credible gold exchange standard for their currency. I would think that's probably going to be the first nation to do it. The Germans could do it, but they would have to come out of the euro. So that's another intriguing possibility. And that is very, very interesting.
Sounds like it's going to be
a mess.
And I'm thinking about the ordinary individual, the ordinary private person and their family, and how they get through, how we all get through this intact. Ahmed Obedat asked a question that's related. It has to do with gold mining stocks. Do you expect a collapse in the gold equities in the upcoming months, and then that they would skyrocket much higher?
No, I don't expect a collapse in gold equities. I would have thought that with gold demonstrably going north, with the world demonstrably printing, print or die, really, I think that measured in fiat currency, gold mines will go up, and they'll go up quite substantially, or they should do. There is a problem down the road, and that is that when fiat currencies collapse, how do you price a gold mine shares? They would have to be priced in gold, in effect. And there isn't a mechanism to transfer pricing from fiat currency to gold, so that you're going to have that period where you may own gold shares, but you won't be able to realize them except on a barter basis for gold. Interesting point, a very, very interesting point. And the same point also applies to cryptocurrencies. I mean, the idea that Bitcoin is a substitute, or if you like, a refuge from collapsing state currencies, fiat currencies, is fine until they actually collapse. What do you price Bitcoin in then? The answer is probably gold. And if you price Bitcoin in gold, it loses its functionality. So that's an interesting thought.
You lost me on that last point because several precious metal-backed crypto projects have come out to where that they see a synergy between the two, where the crypto, but you're saying Bitcoin isn't specifically set up that way.
No, it's not. Bitcoin is set up in such a way that its price is driven by its relative scarcity compared with paper currencies.
Regarding the fate of banks, Pierre Tremblay asks, banks have a huge amount of gold. Would it be to their advantage to raise the price of gold according to the standards of Basel III? It could give them the value at 100%. Why wait instead of acting?
No, the banks don't have gold. The central banks have gold, yes. The banks have gold liabilities. And if you look at the LBMA, in effect, they run a fractional reserve system on their gold bank accounts. They will make it extremely expensive for you to run a custody account through a bullion bank. They will persuade you, lower fees, whatever, to run an uncovered or an unallocated gold account, which is basically you are a creditor of the bank. Your account is denominated in gold, maybe, or the dollar equivalent, or your own currency equivalent. And under the standard contract which is produced by or it's a template produced by the LBMA, they do have the option to pay you out, if you want to close your account, in the currency which you nominated in the first place. So they don't have gold, but what they do have is they do have the potential liabilities. The idea in the past was that these banks would be long of gold in London. Now, I can tell you at the moment that the bullion position in the vaults in London is around about 8,400 tons, something like that. About 80% of that is at the Bank of England, and that is held, earmarked as the term is, for other central banks. In other words, It is the property of other central banks who just keep their gold in London at the Bank of England for trading and for leasing purposes. Of the rest, you've got ETF holdings, which are increasingly important. And you've also got private individual holdings, particularly in vaults like Loomis, for example, and Brinks, and so on and so forth. The amount of actual liquidity in London, I think, is very, very little now. In fact, I think it's less than 500 tons, which means that the problems that we've got generating on COMEX can't really be satisfied from London. And that's one of the reasons why the premium just jumped. I mean, it was all covered up with the idea that this is a COVID shutdown problem and all the rest of it. That's absolute rubbish. Not at all. There's just a shortage of gold everywhere. So the idea that banks are long of gold is completely wrong. They're short in London, and technically they're short in London, if not in practice, and they're definitely short on COMEX, and they're short in huge quantity.
Related question by Bal Singh Gill, who says, there is a very wide premium between the spot price of gold and silver and the actual physical bars and coins. In your view, is this premium likely to increase, decrease, or stay the same for the rest of the year?
Well, it'll obviously vary, but given that I put out a note today suggesting that there's a crisis brewing on COMEX, that would suggest that the premium on COMEX would increase.
And so now let's bring it down to the individual. In this backdrop of a train wreck that's now so close we can smell it, what options does an ordinary individual have to decrease the risk to their family? You mentioned increasing cost of food, so any proximity or access you have to get closer to your food supply is one thing.
Yeah.
Other things that come to mind for you?
Well, there is actually only one answer, and that is to have some gold and silver, if you like, to buy the things that you need when currency dies. It's actually as simple as that. And you'd be doing everybody a favor, because by having some gold and silver, you will be one of the people putting it back into circulation, which is required for any economy which relies on the division of labor, and there's no other way an economy actually works, to get started again. So above all, I would say that. And if you look at the collapse of paper currencies, I mean, this is really what the rising price of gold is reflecting, and the price of silver. The signal we see today is very important in that context. Then if you've got gold and silver, you don't need to rush out and stockpile everything now. You can buy things later. You'll find they're cheaper. Cheaper in gold and silver, but not in paper.
Terms. Yeah. Now, you mentioned the economy of services as well. Gary Nigel Draper says, does Alasdair think that workers with the skills and training relevant to any economy will be able to ask employers for a commensurate wage? And does he think that the wage could reasonably demand it in a tangible form?
I think the first thing I would say is that what we're seeing at the moment is an enormous change in the economy. What consumers want tomorrow is going to be very, very different from what they wanted yesterday. I referred earlier to, people aren't going to be rushing out buying fancy SUVs anymore. They're going to be buying more food, and more energy and essentials. They won't be going out to restaurants so much. So you can see that in the service sector, there's going to be, I think, quite a bad hit, because a lot of services people aren't going to take anymore. I mean, because taking services is very often optional. Sometimes it is compulsory, but usually, I mean, if you're talking about holidays, you're talking about going out to a restaurant, you're talking about getting a gardener in to do the work for you, talking about getting a painter in to paint your living room. No, you probably do that yourself. So you can see that all those services are likely to take a very, very big
contract.
hit.
Mm-hmm.
Yeah. Now, inevitably, what happens is that you get a lot of employees, a lot of self-employed people working in those service businesses who will have to take a far lower return if they're going to remain in business. Either that or try and get out into some other business. The problem with getting out into some other business is that if the government wasn't interfering, you would find that businessmen, entrepreneurs would very, very quickly take up the opportunity of resources being freed up from making the things we wanted yesterday to produce the things that they think we're going to want tomorrow. And where they get it right, they make money. Where they get it wrong, they have to again switch and change. And it's like that with employees. I think that one of the points about what's going on is that we can no longer look to the government to protect us. That is coming to an end, because when the currency goes, they got no means, if you like, no easy means of taking money off you and I to redistribute to someone else, which is actually what they're in the business of doing. So the situation for employers and employees, I think, is going to be extremely confusing. I think the confusion will last longer as a result of government intervention. All history shows that if government stands back and lets you and me sort it out, rather than spending money we haven't got to try and come up with a solution which they cannot do, then the whole thing sorts itself out really a lot quicker. I mean, the depression, and it was a depression, between 1921 and 1922 in America, I think unemployment went up to over 25%. It lasted 18 months. That was it, 18 months. Whereas you had Hoover and then FDR trying to manage the economy. I mean, he was still in recession when World War II came along.
Right.
It was a complete disaster. They're going to do it again. They're going to try that again. The only thing that will stop them is the collapse of the currency. So, the collapse of the currency is extremely uncomfortable for everybody. I mean, I'm sure we'll survive it. There will be a lot of poverty, a lot of hardship. Of that, make no mistake whatsoever. But if the currency is destroyed by government, then we have a better chance of coming out of it more quickly than we would otherwise. And I think that's one of the bonuses, if you like, I can see of the change, and it's tremendous change. But I'm ignoring the political consequences, which, of course, as we saw after World War I in Germany, with their hyperinflation, led to Hitler and all the horrors that followed after that.
Well, Alasdair, you've given us a lot of food for thought, and I hope people are getting the message that you've been diligently trying to get out there, and that is that things are coming to a head and people need to get their affairs in order right away. So we just thank you for your presence here with us again on Liberty in Finance and Reluctant Preppers. That's
very much my pleasure, DK.
I didn't ask you this one. I was going to ask you, but I think you've hit the nail into the wood. Anti-Ignorance says, Mr. Macleod, I have just one and only one question. Do you really, really, really think that the main fiat currencies will die by the end of this year?
Yes. I mean, obviously, we don't know until it happens, but all the signs are that this is happening a lot more quickly than anybody thinks. I mean, I talk to people who think the same way as I do, but they think, oh, another 2 or 3 years, always another 2 or 3 years. So we'll see.
Fair enough. Thank you, sir.
That's very much.
I hope we can have another conversation in a few weeks and not be no internet, no whatever, no phone, no lights, no motor car. Okay.
It's better. Did I tell you the story? Eventually, it failed at this end.
Oh yeah. You said you got it. You got it fixed. This works much better. Yeah.
And the squirrels were eating the
Yes. Right. In the U.S., we say that there's bugs in the system, but in Britain, your translation is that there's squirrels in the system. No, I'm totally kidding. Okay. All right. Thank you, sir.
Anyway, we'll talk again soon.
Take care.
Thanks.
Bye-bye.
Bye.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.